Ever thought about controlling 100 shares with just one contract? Calls for upside, puts for protection. It's a game changer. Buyers have limited loss, but careless sellers face unlimited risk. Stick around to learn the simple rules pros use to shape risk and get paid. This could be your ticket to smarter trading.
Gary, I'm going to keep it moving forward. This has been great. This should be a 2-hour show at this point, fireside chats, right? But Gary, thing number 6, again, 20% extra value this week on the CPI versus PPI issue, DKI's 5 things to know in investing this week. We're talking our educational topic, understanding call and put options. I know in my conversations, again, amateur investors, novice, right? Learning, becoming intermediate, growing as we're understanding markets, business, etc. But this is always one like, okay, understand buying, selling. What are these option things everybody's talking about? So, Gary, let's start. What are put and call options?
All right, so we're just going to make this really simple. An option is the right to buy or sell 100 shares of a stock at a particular price, at a particular time, or before a particular time. So if you have a call option, say, I'm going to make this up, say, end of September, $100 call options on a particular company. Each one of those enables you to buy 100 shares of that company on or before the end of September for $100. And the price could rise, and you could make the money that you would make would be the difference between $100 and the current stock price, less, of course, the cost of the option. Now, put option works exactly the other way. If you own a put option, it gives you the right to sell 100 shares of stock at that same price, or whatever price you have as the strike price on the put. So calls, you have the right but not the obligation to buy. Puts, you have the right but not the obligation to sell. And they all have an exercise price. That is the price at which you have agreed that you could buy and sell. They have an expiration date, right? And there's an underlying security. And those are the key things that you're going to look for. Now, some people who are experienced options traders will say, okay, wait, but there are other things too. There are the Greeks, there's Gamma and Vega and Delta, and there's various other other factors that go into the price of the options. That is all true. That does all matter. It's beyond the scope of a basic conversation. In our educational topic, we really want to make sure that we don't go into advanced calculus and just keep things approachable for people. So when at the basic level, we're gonna simplify it. You have the underlying security, the date of expiration, whether it's a call or put, and the final thing would be the exercise price. So I think we've explained all of those, but if any of this isn't clear, ask the question, put it in the comments. I promise you we'll give you a good answer.
Yeah, IR at deepknowledgeinvesting.com. You can head to the website, deepknowledgeinvesting.com. Click the Ask Gary link at the top of the page. Okay, Gary, let's break it up. Calls, buying a call, selling a call. Walk me through that.
All right. If you buy a call, the maximum amount of money that you could lose is the amount of money that you spend on the call options. You can't lose any more than that. The call might expire worthless and you're just out the money that you spent buying the option. The amount of money that you could make is theoretically unlimited. So if we use the example we gave before, you buy 100 strike options. Maybe the stock is at 80 and I'm making this up. It goes from 80 to 1,000. Well, guess what? You would make $900 per share times 100. Well, you've done pretty well on just one option contract, but your theoretical gains there are unlimited. When you sell a call, it's the exact opposite of that. You are guaranteed to take in the option premium. That's the cost of the option. And you get that. That is your profit. That is your money. And that's guaranteed that you receive that. But the amount that you could lose is theoretically unlimited. It's the other side of writing that option up. Somebody might say, well, wait, why would I ever do that? And the answer might be you might own the stock already, and so you could deliver your own stock against it. Or you're willing to buy those options at that stock at a particular price. And there are all kinds of reasons you would do something like that, or if you just think things are mispriced. There are various ways to control risk. There are spreads that you can set up. Again, it gets very complicated, but the simple version is when you buy, you are definitely out the cost of the option. Your profits are theoretically unlimited. When you sell a call, you definitely receive the cost of the option. Your theoretical losses are unlimited.
Got it. Gary, let's flip the script now. Buying put, selling put. Walk us through it. And just so everyone knows, we have a written version of the 5 things. So every week you've got a written version, material, graphics, right? We'll have to get I know we chop this up. This is the live version, but the chopped up one, I think we'll have a graph up there, right, with our graphic. We're improving all this stuff, but yeah, just so everyone knows, multiple different versions of the 5 things, audio, video, written, to make sure you get whatever you need to get all this good information. So Gary, buy put, sell put.
Okay, yeah, Rob, you're making a great point here. The graphics that we use in the written version do make things much more clear, and they're designed for that. Anyway, put options, it's the exact opposite for call options. If you buy a put, you will definitely be out the cost of the put. And what you're hoping is that the value of the security, the price of the security, will decline. Now, your gains, your potential gains, there are limited to the difference between the exercise price and zero. The stock can't go below zero. So you could make a lot of money on a put option, but not an unlimited amount if you own it. If you're selling a put, it's the opposite. You are guaranteed to receive the price of the option. So you're going to take that in. If the stock stays the same or rises, if it's above the exercise price, your profit will be the price of the option that you took in. If the stock drops, the most that you could lose is the distance between the exercise price and zero less the money that you were paid for the option. So you could take large losses there, but not unlimited losses. And again, people who do this may own the underlying security. They may be hedged in other ways. They may be buying one option and selling another. There are all kinds of sophisticated strategies. So the risk may not be what it appears to be in a particular security. Or, one of the things that we'll do sometimes is, I might say, well, I don't want to buy the stock at a current price, but I'd buy it down $20. I'd buy it down $30. If you sell put options, then if the stock goes up, you take in the value of the option. You take in the price of the option. But if it goes down, you may end up getting to buy the stock at the price that you wanted. So there are various ways to use these things to control risk or add to profits.
Yeah, and Gary, I think my question, I kind of laugh, is what's the difference between like professionals, I'd say, and how amateurs or novices maybe should be using call and put options? And I always laugh because I think one of the things that you told me when we first started talking was, Rob, how would you feel if I was the other guy, I meaning you, or the other guy on the other side of your trade? And I said, well, Gary, I probably would not feel very good about that trade because that means you think the inverse of what I'm thinking, and you're spending a lot more time on this stuff. Not that I, not that, hey, we don't make mistakes, or I see things different ways, right? You learn in every which way. But anyways, yeah, some of this stuff can get complicated. Intermediates, amateurs versus professionals in terms of use of these options.
Yeah, so, Rob, one of the things that inexperienced amateur investors will do is they just use options to magnify potential gains and losses on stock positions. In recent years, we've seen a huge increase in the 0 day to expiration options, where people are buying options on the day of expiration, hoping that the underlying stock will move. And, if it doesn't, they lose 100% in a day. If it does, they can make a lot of money in a day. I was talking to a friend of mine the other day, and he turned in a matter of a few months doing stuff like this $7 into $1,500. And you think, okay, wow, that is phenomenal. Good for you. And I said to him, okay, what happened next? He said, well, I lost it all. And in his view, he said, but I only lost $7. I don't know. You ran up a $1,500 profit, but there was no risk control on any of that. These generally, doing this kind of stuff is really much more akin to gambling than it is to investing. Professional investors will often use options instead of to magnify gains and losses. We'll use them a lot of times to modify risk, to create synthetic shorts. That's selling a call and buying a put. I'll use spreads on things where I may buy one option and sell another option that's further out of the money just to control risk. We'll do things like sell a stock that we own above the current price, that's selling a call, or to profit while trying to buy a stock at a preferred price, that's selling a put. This is something we talked about, in an earlier part of this segment. There are all kinds of different trading strategies that can depend on timing, catalyst, whether the investor already owns the underlying stock. So there are all kinds of things that we're considering in terms of risk control and portfolio management that the people buying 0-day to expiration options are not. As always, we advise proceeding with caution, having a clear investment thesis, and thinking very hard about whether you're taking unintended and unlimited risk or not. At DKI, we have used options occasionally and very profitably when positions trade down substantially on news that we consider to be temporary or unimportant. But to do that and do it well and do it profitably, you really have to have an investment thesis on this stuff and have to know how much you're risking and be able to limit that risk. Those positions have tended to work out really well because we do have a clear understanding of why a position is down and why we disagree with the market on that. For people who are interested in subscribing, our goal is to make you a lot of money, help you make a lot of money over the long term. Please don't think that, every week there's going to be a new options trade that makes us 40%. It does happen on occasion, but this is not, a regular part of the business. It's really just when something dislocates and we see a very unusual opportunity. So we do this stuff profitably, but not on a daily basis.
Great stuff there, Gary. And yeah, if you have any questions, head to deepknowledgeinvesting.com, use the Ask Gary feature, and we'll get those answered for you for sure.